If you're self-employed and want to buy a house but been told no, you don't qualify, claim more income, don't deduct this money, file your taxes, then we'll get you approved, then this video is for you. I'm going to bust up some myths versus reality regarding business owners' belief or lack thereof about getting a mortgage. As a business owner myself, I know that you can run against unique challenges when trying to get a mortgage, leading to discouragement, frustrations of being told that you don't qualify, don't report enough income, that you just need to claim your income on your tax returns so that you can actually go ahead and get approved for a home loan. I'm going to challenge the thinking on that because I'm going to say, why would you bypass the tax code as a business owner to qualify for a home loan? Many lenders, especially those at banks, will tell you can't get a mortgage if you're self-employed, that you need to claim more income. We need 2 years of tax returns. That is just not true because the banking industry, and they works with no financing. The fact is that you can get a mortgage when you're self-employed. You don't need to have had 2 years of tax returns. I'll give you a couple iterations of that. Did you know there can be up to 8 ways to qualify when you're self-employed for non-traditional mortgages? Number 2, you don't need 2 years of tax returns to qualify. It's widely assumed that self-employed applicants must show 2 years of tax returns. Those banks do want 2 years of tax returns. That's pretty standard. I hear that a lot, and I'm shocked because it's just not the case. In fact, even in the traditional space, there are iterations where you can get by with 1 year of tax returns. Keep that in mind for those that are transitioning from a W-2 job in the same line of work. Once you have 1 full year of tax returns, you can get a traditional loan. So when you're self-employed, let's see if we can get you qualified traditionally, because the truth of the matter is those interest rates are lower. It does open the door to lower down payments. That's just not the case for a lot of my self-employed people because y'all write stuff off, rightfully so, because of the tax code, as you should. You could get by with that 1 year of tax return showing a full year of self-employment income. Example would include HVAC, plumbing, an attorney who was at a firm and now on their own. I'll also share with you that if you're at a professional services company and you get partnership, you may have then a K-1. But with a lot of those big corporations, there is a waiting period because they will extend the tax return. And we can get by without a single tax return if you were granted partnership in a firm. Number 3, that you need perfect credit to do this. And that is just not the case. We're going to be looking at cash flow, at stability of the income for the business, and we will look at credit because that will have a potential impact on your down payment. As an example, if you had a 660, you might need 20% down. But if you have a higher score, you can get by with 10% down on a business owner loan using the business financials. And why is that important? Because on a $600,000 property, that's the difference of putting $60,000 more or less down between 10 and 20% there. You don't need perfect credit. If you start with the lender early enough, you can have them help you hack your credit score up so you can put less money down. Make sure they understand these types of mortgages. You can put down 10%. Number 6, we're going to use pay stubs. This is not the case. What we're going to look for in these non-traditional spaces, it could be a profit and loss. These are some examples. I mentioned there's up to 8 ways to get approved. Those are just 2 examples. And with the bank statements, we're probably looking at 12 months. If your spouse is W-2, that person can be added to the mortgage. As we wind down here, let's break down a real life example. So think about this. Traditional space, I have my tax returns. Not traditional space, maybe I write everything off. $600,000 property, 10% down. Traditional loan versus bank statements. On a conventional loan right now, you might see 6.875. So on that $540,000 note, that's $35.47 a month. If I get my bank statements, why would I pay a point and a half higher and $560 more per month? And I'd say, well, that's valid. That's close to $7,000 a year. But how much are you going to pay the IRS in taxes so that that income is on your tax return? If you were to pay them $25,000 to $50,000, but yet you kept it, what would you do with it in the business? How would you use that to grow your business? Maybe that's payroll, acquiring new accounts, new technology, new machinery. Think about it. Remember, mortgage interest is tax deductible. So before you go making a decision with regards to this, you should certainly talk to your CPA. If you like this kind of content, make sure to subscribe. Be well, and we'll talk to you soon.